everybody. Luke Gromen, FFTT. Hope everybody had a great weekend and stayed warm for the cold part of it. And today, at least here in Cleveland, it was almost 50 degrees again. On our tree rings product. Luke, a splendid recap of an amazing week. When you understand the big picture and why things are happening, it gives you confidence to stay the course. Your help has been invaluable to me. Thank you. From subscriber BD. So thank you, BD. I really appreciate that feedback. And now we're going to jump right in to the two things that grabbed my attention recently. The first is on weeks like this, tough weeks, I think it's always good to revisit this 2015 quote from former Fed Chairman Alan Greenspan when he said, "A surprisingly large percentage of U.S. income tax receipts are tied to a rise in stock prices. When the U.S. stock market just stops rising, not falls, but just stops rising, that will put pressure on the receipt side of the U.S. fiscal picture, which no one is talking about." And so I think it's an important thing to remember in terms of understanding, number one, that the Fed knows this. If Greenspan knows it, the Fed knows it. And number two, how quickly they are likely to react. So that's the first thing that grabbed my attention in the context of what we saw this week in the markets. The second thing is that my Twitter feed has become nearly 100% coronavirus. I haven't seen a panic like this in quite some time, and maybe it's warranted. I did tweet out last week. I just wanted to put some context on it, and what I found was that from the Chinese stats, which you take with a block of salt, but from the Chinese stats, they said that someone my age, in my age range, would have about a 0.4% chance of dying from it if I contracted it. And I just, for context, decided to look up the Social Security Administration's actuarial statistics for my age and found that my chance of dying over the next 12 months, just from anything, is also 0.4%. And so for me, obviously, I think in certain demographics, in certain health situations, it's a very different story. But for me, I wasn't terrified of dying of something, a week ago when I woke up. And so I think, for me, there's a couple takeaways. First off, it suggests there's probably a lot of fear already priced into markets based on this, unless things get a whole lot worse. The second thing is that I think it's important to remember as it relates to markets, again, and this ties back to the point on the Greenspan point that we led off with, or the Greenspan quote, which is Congressional Budget Office assumptions, central bank assumptions, they're all based on nothing going wrong basically ever again. You look at the CBO numbers, the sort of crazy deficit and debt numbers the U.S. they expect to run are based on no recessions through at least 2029. So to me it suggests, number one, something has gone wrong. And so they're likely going to need to respond aggressively and relatively quickly. The second thing that grabs me about all this is that those saying that the U.S. can quickly decouple from China relatively painlessly, I think have been proven wrong, very wrong. We're already seeing, what's still in the grand scheme of things a relatively modest disruption. You've seen it take the fastest drawdown in the market from the highs, 10% drawdown in the highs, in history. And so what we've been saying all along is if you wanted to quickly decouple from China, or if the U.S. had to decouple from China quickly, you would either have to shut markets down for a period of months or years, like happened in World War I, or the U.S. markets themselves would have to go, quote, full Chinese. In other words, the Fed would have to buy whatever's needed whenever it was needed to keep asset prices elevated, to keep consumption and GDP growth going. So those are two things that really grab my attention from that. I'm going to jump into a few questions here before we hop. First off, the gold and silver move last week. What's the effect of a rate cut in the current situation? I think all else equal, a rate cut would be positive for both gold and silver. I think the fact that you saw gold and silver getting hit in a margin call type way as sort of the last things people wanted to sell, I think is encouraging in terms of people seeing structural strength in it. But I also think too it's important to note signs that when you see the CME hiking margins, as reportedly happened last week, when you see somebody come in and sell a whole bunch of gold in 60 seconds, that's a sign of effectively currency interventions. Somebody with a lot of juice wanting to start running some stops on the downside, and it certainly worked. So the gold-silver ratio is a follow-up question from someone. It's at or still near highs. I expect that to continue. I think we've touched on this before. Ultimately, we're in a global sovereign debt bubble that is bursting, and there's two ways out. Either the debt defaults or the debt defaults on a real basis. And it can't default nominally, so it's got to default on a real basis. It has to be written down against something else on central bank balance sheets. And Swiss National Bank and the Bank of Japan own stocks, but all of the central banks own gold. And so ultimately, we think gold's going to need to be written up relative to the stock of global sovereign debt, and that would imply that the gold to silver ratio could continue to rise. So we still favor gold to silver. I own some silver, but I do favor gold to silver. From Ritesh, what could the budget deficit look like? What could be the budget deficit if stocks fall another 10% and stay there? Is it not in the Fed's interest to come out with some strong measure today, because later they'll have to do a lot more and under severe pressure? I think the best way to think about that, I think it's a really important question, it's a great question. I think it's the best way to think about it is, a week ago, equities were 160% of GDP, and taxable IRA distributions plus net capital gains per the IRS. As of 18 months ago, we're about 200% of annual growth in personal consumption expenditures. And PCE's 2/3 of GDP. So the bottom line is the U.S. economy can't grow unless stocks are rising, mathematically. And so the math on all of this is, let's say stocks fall another 10% from here. That likely puts us in a recession, given stocks used to be 160% of GDP. You would be looking at 5 to 8%. The last two recessions, deficits rose by 5 to 8% of GDP, just counter-cyclically. So you'd be adding, call it 1.1 to 1.7 trillion to the deficit. Year to date for the fiscal first half, we've run about 700 billion in deficit. So we're running at $1.4 trillion in terms of debt issuance. Add 1.4 to 1.7 on top of that. So you'd be looking at 2.8 trillion to 3.1 trillion of U.S. Treasury issuance in the next recession. Arguably, and foreign central banks aren't buying. Foreign private sector buyers are not buying nearly enough, especially with where FX hedged Treasury yields are. And so you would be looking at 200 to 250 billion per month in Fed QE needed. And that is assuming that no emerging markets anywhere sell any treasuries. And just in the slowdown in 2015, they sold about $1 trillion. So you could conceivably add 100 billion a month more on top of that if emerging markets started selling treasuries, in terms of the effective treasury supply. So, the bottom line is, to your point, Ritesh, the Fed is better served to act quickly and aggressively, because if they don't, they're going to have to print face-peeling amounts of money in terms of the balance sheet growth to help finance U.S. government deficits. So, in terms of when Fed action, that's, suggests, we think, sooner rather than later. And then the last question here, when does the milkshake end? At zero interest rates or negative interest rate policy? And so the dollar milkshake from our friend Brent Johnson, we've been discussing it a lot more recently. He's, of course, been discussing it a lot as well. As Brent defines it, it's tighter monetary policy driving a higher dollar and also higher U.S. stocks as capital flows here. And when will it end? Our view is it really has already ended. From here on out, it can only be a brief temporary phenomenon. Ever since FX hedged Treasury yields went negative in the third quarter of 18. And as long as they stay negative, basically what that's going to do is force the U.S. private sector to finance more and more of its own deficits, particularly as global central banks are no longer buying treasuries on net. And so what that means is that the U.S. banking system, the U.S. private sector has had to finance more of those deficits. So all of a sudden, the stronger dollar of the dollar milkshake doesn't choke out emerging markets, it chokes out us. It chokes out our own economy, and we've seen this. So ever since then, 3Q18, the Fed had to back off, after the 3Q18 market correction, right? So we had stocks down. That's not part of the milkshake. You had the Fed have to back off and then begin to talk about rate cuts, and so they take away the stronger dollar side of that. That allows stocks to rebound, and so basically I think we're going to oscillate as it relates to the dollar milkshake, where you will have brief periods of time where it works. So for example, since January of early this year, Fed tightened policy. They began running off the repo book. Balance sheet wasn't growing. Dollar rises, stocks rise, and then boom, something happens, and 2 months later, the market sort of falls all over itself, and now we're talking about 100 basis points of rate cuts in the next year potentially. So I think it's going to be, dollar milkshake for a couple months, and then the Fed's got a cut or the dollar's got a weekend type of thing. And then they stabilize the situation, stocks turn around, and the Fed talks about tightening for a bit. So it's just going to be this back and forth, and I think the back and forth periods are going to get shorter and shorter and shorter and shorter. And I think we're going to wake up one day and it's going to be like, you know what, that's sort of it. So at any rate, that's it for tonight. I appreciate everybody joining me. In the meantime, if you enjoy these updates and just sort of the thought process that goes into it and the lens, I think you'd really enjoy FFTT Tree Ring. So check that out, FFTT-LLC.com. Also can get updates in terms of what we're up to and etc. Otherwise, everyone have a great week, and we look forward to chatting with you soon. Take care, everybody.